All right, I think we'll go ahead and get started. Thank you guys so much for joining our 401k open enrollment presentation. We do have our advisors from Free State here with us to do a plan overview and then also a spring update. So questions are encouraged through chat function. If you hover over the bottom of your screen, you should see a little toolbar pop up, and there is a chat bubble that pops up, and you can ask a question to the group. You can also ask a question privately to me or to Nathan or Lysandra if you want to keep your question private. So either way, we will get to those questions timely, usually at the end of a slide. And then if you do see that maybe your chat or your question was skipped, it might be because we are going to address it later on in the presentation and it will get covered. So with that being said, we'll go ahead and get started. Nathan and Lysandra from Free State will be going through this presentation, and I will be monitoring our chat function for any questions. And if for some reason you're wanting to review this later, I am recording these, so I will be sending this out to all of our associates later for additional follow-up.
All right, thanks, Katie, and good afternoon, everyone. This is Nathan Haskins, and I am an owner of Free State Advisors. I've been working with Michael Thomas for over 3 years now, and I know he and Lysandra have been working together with you all for a long time as well. So I'm honored for the opportunity to talk through your plan and really give an update on the economy and markets and answer any questions that you've got. So if you do, please don't hesitate to chime in through chat, and we'll make sure we take care of those along the way, and then we'll open up some time at the end as well. All right, we talked through the agenda, first plan overview, and then we'll get into the rest of it. And the first thing we wanted to do as part of the plan overview is talk through some enhancements to an already very generous plan. Some of you may have heard the term safe harbor, or some of you may have worked other places that have different types of, vesting schedules and that sort of thing. At QServices, your leaders and the business recognizes how important and how valuable a retirement plan is to you and your future. And so rather than putting money in and making you be at the company for 2 years or 3 years, or most companies are 5 years before their match is your dollar, a safe harbor plan means that you're vested 100% right away. And in fact, for the first 3% that you defer into your 401k plan, the company is going to match dollar for dollar. Starting this year and going forward, they've sweetened it even more, and that they're matching, 75 cents on the dollar from 4 to 6%. So most companies, don't allow a 100% vesting right off the bat. B, when they do, most aren't as generous as the additional 75% on those dollars above 3. So that's all part of a very generous plan, and that's frankly in addition to profit sharing on a discretionary annual basis too. So that's a tremendous benefit, which puts you well beyond what most employers are at. So I'm sure if you guys have been other places before, you may have seen some things like this, but know that as we look across many different plans in the business, this is a very generous plan. A few administrative type things. So all salaried employees are eligible once you've been there for 5 months. After you've kind of passed that bar at 5 months of service, the first day of every quarter gives you an option to get started in the plan. And once you do get started in the plan, we'll talk about that in a minute here, but it's very easy. In fact, you have to take action if you don't want to be started in the plan. Because again, the goal is to realize the value that the 401k plan gives you for the future. So the company is helping you and doing everything they can to support you doing your part to save for yourselves and your families. One of the really nice things about a 401k plan in general is that the contribution limits are much higher inside of a retirement plan than they are outside of a retirement plan. So some of you, for example, may have contributed to an IRA or a Roth IRA in the past and hit, a contribution limit of like, $5,000. And this year it's $6,000. Well, that's not the limit within the 401k. In fact, you can contribute up to $19,500. Or if you're 50 or older, you can contribute even more because the IRS realizes you are getting closer to retirement, and they give you the latitude to be able to contribute more than that. So effective this year, up to $26,000 in deferrals into the plan, and that goes a long way toward saving toward your retirement. We touched on vesting, but again, rather than making you wait, several years, like many other companies do, before those match dollars become 100% yours, you are 100% vested right off the bat. So, with each paycheck as you're saving into your 401k plan, that match that QServices provides for you is already vested. So if you're doing that and you retire, even if you weren't there for 5 years or whatever, those are still your dollars. And that's a great benefit and value to you as part of being in this plan. I'll touch one more page here, and then we'll stop for questions for a second. So I mentioned easy to get started. You are automatically enrolled as you get started and become eligible to be in the plan. The only way that you would not be in the plan is if you actually opt out of it. And in fact, not only can you pretty easily get started in the plan, each year right around this time, as generally, there are often raises, that sort of thing, the plan can automatically increase your contribution by 1%, up to a maximum of 6%, because normally as, part of getting a raise, you are going to not feel saving a few extra dollars for your future, and it is the best systematic way to save for yourselves. If your family is anything like mine, I know that once those dollars hit the checking account, they just tend to go away. And so the 401k plan here gives you the chance to carve those out of your paycheck before they hit your checking account, and that way you can rest assured that you are saving for your future. And having that systematic way to pay yourself first is an extremely valuable thing. And even small things like, the additional 1% per year means that you're saving more and more as time goes. And, really not hopefully feeling, a ton of sacrifice associated with that. But it does add up to be, big over time, especially when you're young and you've got time on your side. There are different options to invest in that we'll talk about here in a few minutes. If you don't choose to manage your own fund allocations, by default, your dollars go into what's called a target date fund. And what that really means is a fund where professional money managers allocate your mix of stocks and bonds across an array of different funds and assets based on, what's going to be best with the number of years until you get to retirement. So, for example, if you are 35 now and you're looking at retiring at 65, you're probably looking at the your 2050 target date fund, and that's going to be about 90% stock. The further you are out from retirement, the more stock you're going to have, because over the long run, even though there are road bumps along the way, the stocks are going to deliver the best outcome for you, during this accumulation period. As you get closer to retirement, again, we'll talk more about this, but you start to dial back in the growth and start to look at income and capital preservation more. So I'll pause now for any questions on kind of the initial overview of the retirement plan.
So one thing, if you can go back a slide, Nathan, I wanted to mention to people under this eligibility bullet up top, that does include our are hourly associates as well that are full-time. So all salaried and hourly associates are eligible for the plan on the first entry date following completion of 5 months. The only exception is when we have a part-time associate, it will take them longer than 5 months of service to be eligible. But full-time hourly associates are also eligible after the 5 months of service.
Awesome, thank you.
Yeah. And again, if you are having trouble finding the chat function, you just hover over the bottom of your screen and you'll see that little chat bubble if you'd like to ask a question.
Okay. Well, another great option within the retirement plan is the ability to choose either pre-tax or post-tax contribution. So generally, folks are used to contributing pre-tax dollars, meaning if you made $100 in a pay period and you're putting in 10%, you would take 10 of those dollars and put them into your 401k plan. Very straightforward. The difference with the Roth option or the after-tax option is that you pay tax on it first, but then your dollars grow, and when you go to pull them out in retirement, you take them tax-free. In the pre-tax option that I described first, you don't pay any tax up front, and it grows without taxes along the way, and then you just pay ordinary income tax when you go to take it out in retirement. So mathematically, those options are going to work the same if your tax rates stay the same throughout, today on through retirement. And we don't know what the tax code is going to do or, your income's going to do, but generally speaking, it's likely, I think, that taxes could go up in the future. So if any of you believe that taxes will be higher down the road when you're retired, it could also be advantageous for you to use that Roth contribution option because within the plan, again, it's a systematic option where you're doing that before you have a chance to spend it. So you're paying yourself first, and then you're paying the tax now so you don't have to pay it later. And you can contribute, far more to your Roth qualified plan through the retirement plan than you can outside of it. So if you have at all considered doing a Roth IRA, I strongly recommend that you do it as part of your retirement plan versus trying to do that outside because you've got the advantages of being able to contribute far more to it. I'm going to pause here because I know sometimes there are questions about the Roth option. Did that help, or does anyone have any further questions? Okay, well, I'll keep going, but if anything comes up, please just note it in chat. We can come back to that afterwards too. Okay, last but not least, once you are part of the plan, one of the things that we recommend for our clients is really to try to consolidate as much as you can. Administratively, I know it can seem like a daunting task, but trust me in saying that as you approach retirement, it's not nearly as daunting as trying to manage IRA accounts that are spread out all over the place. I can't tell you how many folks we've helped that have 6 or 7 different accounts, and sometimes you forget one. You certainly don't keep track of managing what they're invested in. So to the extent that you can, I strongly recommend that you as you change employers, as you leave 401k plans, that you consider consolidating those into an IRA, or like this your 401k plan here at QServices, because it lets you have one place to see and manage those retirement dollars. And again, the paperwork is not too bad, and you'll thank yourself later as you A, don't lose the accounts, but B, can see and manage those. So any questions on that?
We actually did get a question about the Roth and traditional,
Okay.
I think what this means is, should you max out traditional 401k and then go to Roth? So I'm not quite sure what that means. You mean like on an annual basis, max it out? But like, is there something that, you should do with traditional, and then if you have leftover funds, move it to Roth? Yes. Okay.
Well, yeah. So the $19,500 limit for those less than 50 includes both your Roth and your pre-tax contributions within the plan. So if you can swing that using the Roth bucket, right? So after tax dollars, I strongly encourage that, because again, down the road, when potentially you may have higher tax brackets, you're going to not only let those dollars grow tax-free, but you're going to pull them out tax-free. So that's where the advantage of having the higher limit inside the retirement plan is, versus trying to contribute to the Roth IRA outside of the plan. Does that help? All right. If not, let me know, and we can definitely come back to it. Okay. Can I access my funds? So these are your dollars for retirement. And the IRS really sets this up with a lot of advantages for the retirement plan, intending that you do make them for retirement. So the happy path here is you save as part of every paycheck, you invest, this retirement account grows and grows, and once you reach age 59 and a half, you can start to take withdrawals without penalty. At 59 and a half, you can even take withdrawals out even if you're still working. But generally, once you get to retirement age, beyond that, this is one of the main types of accounts that a lot of people rely on for retirement income. You generally are going to have some Social Security. You may have other accounts, and your IRA adds a tremendous source of income for folks in retirement who have saved for it. Now, prior to, being 59 and a half and starting to take planned withdrawals, there are exceptions for hardship withdrawals. So the 401k plan is not like a piggy bank at home where you stash money away and, if you come up short on the car payment or something, you don't dip into the 401k to pay that. The hardship withdrawal is really pretty strictly administered for a set of circumstances that become very financially challenging, right? And these are IRS defined. It's not something that is laid out by, your plan administrators. It's truly limited to things like medical care, challenges with the principal residence, funeral expenses, things like that, or federal disasters, typically like natural disasters. So in situations like this is one where you've got to have the paperwork to demonstrate the hardship. And with that, yes, these are your dollars. You'll have to still pay, the income tax on it and that sort of thing. But if you are in a tight spot and meet these hardship guidelines, these dollars can be used prior to 59 and a half as well. Any questions on that?
So when you say guidelines, I just want to, be aware, everyone to be aware, when it says repairs to principal residence here, I mean, this isn't updates, it's not remodels, it's, like a catastrophic event, like a tree fell on your house type situation. Yep. So if you're just wanting to do a remodel or, something like that, then that's not really what this is for.
That's right. And our good friends at the IRS provide a lot of documentation on these hardships that we didn't want to bore you with in the presentation, but can certainly provide, guidance if you're in a situation like this to understand whether they qualify. Okay. Well, let's get into probably one of the more interesting economic outlooks I've provided in a while. Because 2020 has thrown us a curveball. A month ago, as I was talking with folks, it was a bit of a different story. So at that time, unemployment was nothing. We were at full employment. New home buying activity, building activity was very strong. Consumer sentiment was high and spending was strong. Like, we were really chugging along. And then this guy called the coronavirus came along and has created some upheaval and uncertainty for all of us, not just in the United States, obviously, but around the world. So effectively, we came into this period of uncertainty with a very, very strong economy, albeit at the end of a very long and good business cycle. But growth has been impacted significantly, right? So starting in other countries, things started to close down, and now we're seeing it here too, where parts of the economy are just kind of paused for a little bit. That's going to have an impact, obviously, to revenues and to employment, at least in the very short term, and different things like that. So investors have taken the anticipation of a softening in the economy and really projected that into the stock and bond markets, and so that's what we'll talk about here in a second with investments. But from a pure economy perspective, you're seeing a slowdown in revenues. You're seeing costs go up, and generally this period of uncertainty. So this may be the first time that Mr. Coronavirus has appeared and done something like this. But these types of impacts to the business cycle come along periodically, right? So in 2008, it was a financial crisis. In 2000, it was a technology bubble, right? You go back to the 60s and 70s, and you name it. This is a regular pattern that is just part of a healthy economy. So the question is not, will the economy recover? It really turns into, when will the economy recover? How will the economy recover? Because all of that really fits into your investments. Stock prices generally always follow earnings. And so where earnings are growing and people are expecting strong earnings to continue to grow, stock prices are going to go up. In periods like this, where earnings are going to come down for some period of time, well, stock prices come down too. That's not a permanent situation, but it's the reality that we find ourselves in today as opposed to a month ago. So what does that mean for your investments? Well, you may have noticed that there's been some big moves in the stock market. Volatility is higher, and volatility is really a measure of uncertainty and a disagreement between investors, right? A day when the price of stocks is down means that more investors think that earnings are going to fall more than a day when prices are up, and there's more optimism around what the expected stock price is, or what the fair stock price is. And so we see that uncertainty playing out in big up days, big down days right now. The important thing to remember is that price is just a number that the market comes to, where other people are deciding on a price between two investors. That number doesn't really represent the actual value of the shares in your 401k, in so much that you've been buying those shares along the way and they're yours. And really, unless you sell those, the value that you have is ownership of, part of a mutual fund, part of a company that is, part of the global economy here. So, again, it's not just like the economy side. It's not, will it recover? It's, when will it recover? I can't tell you when prices will recover. Obviously we've got to let, medically, this whole coronavirus pandemic run its course and come under control. And then on the economic side, it's going to take a bit for business activity and confidence to really pick back up. But we have every reason to believe, that there is a strong recovery ahead. Like I said, our economy was very strong before, and I think that, as risk subsides, as uncertainty it comes down, investors are going to be all in on the United States. And I think that stocks are going to look very good even for other global investors as well. So, you could see a very strong recovery. I think, there will be more uncertainty ahead before that comes. But don't lose faith that we'll get through this and the stock prices will be back. In fact, I would say that the stock prices have been very highly valued now for several years. We all like to look at 2019 and the returns in the stock market. We felt very good about that. But to buy more shares means that you're going to spend more per share. This gives investors, this pullback gives investors a chance to buy those shares while they're on sale. And you're going to get more shares for the same, dollars per paycheck, right? So as those prices do recover, you're going to see more appreciation on the additional shares that you were able to buy when they were on sale than you had an opportunity to before. So I know it can be disconcerting to watch the news and watch the volatility. My recommendation is not to, if you can help yourself, but continue to know that your efforts and the efforts of the people and the companies around you are going to get through this tough stretch and recover very strongly on the backside. So I'm going to pause here to check for any questions on kind of the economy or investments in general. It's very quiet.
Yeah, it is a bit. But I do appreciate you. I think everyone's ready for the weekend. It's been a rough week. But I appreciate that explanation of volatility and how once all of that volatility kind of calms down is when we will see a difference, correct?
Yeah.
So it's just unknown right now, but once everything, kind of settles down, that's when the volatility will kind of go away. So
yeah. Again, the volatility is just a disagreement between investors as to where we're at right now. We'll likely see some quiet periods and then and potentially even very volatile periods ahead. But as more information becomes available and you start to see the economy recover, you'll see that same recovery in stocks and potentially even faster than the overall economy recovers. So I understand it's Friday afternoon, so if you have questions after this, please don't hesitate to ask Katie or reach out to us directly too, and we'll stay connected on it. The only other thing I'd say here is, as we start talking about assets and how to invest, this is a great time if maybe you've made your portfolio more conservative, to change your future allocations to include more stocks. Again, the reason is for every paycheck you have going forward here, you can buy those stocks when they're on sale. And that may seem counterintuitive, right, to be buying more as the prices come down. But think about it more as you would when you're going shopping. If you can get the same same product, the same value for a lower price, doesn't that just make sense? So definitely consider as you get into American funds and make any changes to your account, to make sure that even though it may seem scary with all the volatility, this is a great opportunity to continue buying stocks as we go. All right. So what to buy? Well, really, as an investment advisor, each person, each situation, right, is a little bit unique. The constants really are that as you get closer to taking distributions out of your investment accounts, it's usually a pretty good idea to dial back the risk a little bit. The reason that's good advice is because as you start to rely on your investment accounts to take distributions, if the economy stubs its toe on a virus, you don't want to be in a situation where you need to sell stocks to try to generate income from them. And so often we use tools called bonds to help create a different type of income, and then also reduce the volatility in your portfolio so that those distributions are, you can count on those dollars being a little bit less volatile than you could, in a more aggressive portfolio. So as we look across the different investment options within the plan, we've got options for you to be very conservative. For example, the money market, which is, a low risk and, not a huge returning asset, but sometimes that's really what you need. As you go to the right and you go down in this chart, risk increases, right? So your asset allocation, all that means is this is a mutual fund that spreads assets across different types of stocks and bonds. Generally, it's about a 70% stock to 30% bond portfolio, and some of those stocks are domestic and some are international. So it's kind of it's a good mix, right? The large cap stocks, these are generally domestic, very high quality companies. Several choices from American funds. The Vanguard Total Stock Market Index is, more of a passive, very low cost way to participate in, growth of the stock market. And then there's a global, international stock option with the New Perspective Fund, which has just done a tremendous job over the last few years. So, if you choose to manage your own portfolio and asset allocation, you've got an array of choices here, both to get kind of your mix of more conservative options as well as different domestic and international stocks too. Now, not everybody gets into investments the way, I do. So, if you look at this list and it makes your eyes glossy, or if this part of the presentation makes you want to take a nap on Friday afternoon, there's another way of doing it, and that's called a target date fund. So again, the target date fund is managed by professional money managers at American funds that balance your stock portfolio and your bond portfolio based on the best outcome for your time before you start, before you retire and start taking dollars out. Again, this is all based on when you would expect to retire, about 65, right? So if you are, again, 35 years old now, and you've got 30 years to go until you retire at 65, well, it's 2020 now, so you're looking at the 2050 target date plan. Rather than having to do the math, it's pretty easy to look at this chart of birthdays and say, hey, that's me, or that's me, or wherever you fit in here. And we'll talk in a second here, but the closer you get to retirement and taking those distributions, again, those fund managers at American funds are going to be reducing risk as you get closer to retirement, so that the volatility is reduced and you can start to really plan for more of an income, type of source. The other thing is that there are new funds that launch, every 5 years as needed. So there's actually a 2065 fund that's available, and it's amazing to me that there's a wide array of different ranges in the workforce now, and 2065 seems like a long time from now, but I know there are those of us out there who will be using it too. So know that those target date funds will continue to evolve as we get further along in the calendar. The last piece on the target date is that, again, it's one of the activities that any investor should do, that as your life changes, right, as you get closer to retirement, you should rebalance your portfolio so that you are taking the appropriate amount of risk, right? Again, you don't want to be in a super volatile portfolio, more than likely, as you start taking distributions out, because you don't want to have to deal with the prospect of, selling very valuable stocks at a discount to produce your income. So again, the folks at American Funds that are very good at managing these target date portfolios, so that as you get closer to your retirement date, they are going to ramp down the percentage allocated toward your growth type funds, be those international, be they, the more risky type stocks, and they're going to put more into the fixed income type investments. So they do all that. They rebalance for you. You don't have to set a family meeting on January 1st of every year to look at where you're at and where you should be. This isn't meant to be hard. And that's why it's really the default option. It's as simple as putting your dollars into it and just focus on trying to make the most of that, and let folks who do this for a living, manage and rebalance your funds as you get closer to retirement, because mathematically that should give you a much better outcome than many investors get if left to their own devices. Okay, I'm going to pause again, take a drink of water, wait for any questions. Anyone? All right, y'all are going easy on me. And we'll open up some time at the end as well if we need to. Last but not least, how do you get access to see your account or to make any changes? I think a lot of us really like the online channel. So myretirement.americanfunds.com, go through kind of a standard login process to get authorized. And from there, you can not only see your account, but you can pull down documents, you can manage options within that. Basically take care of the things that you'd expect to be able to take care of. But if online's not your thing, you can also contact them by phone. Again, you've got to prove who you are so that, everything's secure. But through this, you can do some things without talking to someone, like get your, account information, that sort of things. But you can also reach a real person too, to be able to help with anything that may be beyond what you can take care of just kind of automatically. And then last but not least, if you need to kind of raise any questions to us, that's easy to do. Our contact information is here. Either Lysandra or I are around, and either email or phone, we're always happy to answer questions that you've got as well. I know Katie and the team there are always there too, and they help with a lot of the, kind of the plan administration type thing. So, questions about contributions or that sort of thing. And, if they have questions or any of you have questions, we're happy to step in and help make sure they get answered too.
And
okay,
this is Lysandra. I just wanted to quick circle back on some of the changes that you can make to your account online, that you can always suspend your contributions at any time, but if you want to make actual changes to your salary deferral percentage, that's something that even when you put the request in can only be done on a quarterly basis for implementation. So it would be that January 1, April 1, July 1, and October 1.
Awesome, thank you.
Awesome. Well, thank you for all the great information. I will be recording this, so we will be able to send this out to you if you need a recap or just want to go over it again, maybe even with your advisors or accountants or whoever. Remember that we are closing down open enrollment on March 30th, So get into American Funds and take the actions you'd like to do before that. And then you will see any changes that you make on that first paycheck in April, which I believe is April 3rd. So you can plan on that. And then obviously we'll post this presentation out to UltiPro Dashboard for anyone to look at as soon as we get a copy of it. You know, and maybe add some updates or whatever and add my name to it and then Sherry's name as well. And again, you have till March 30th to make changes as long as you are eligible. Remember, after 5 months of service, then you are eligible. So thank you guys so much for presenting for the last couple of days. We know that we've had some challenges and we've had to kind of shift how we do this. So I appreciate you being so flexible and giving us all this information. It's really reassuring knowing that you guys are there and monitoring the market and monitoring our plan and doing what's best. So thank you for that.
Always happy to help. You all have a great
Absolutely,
weekend.
yes.
All right. Well, thanks again, guys. And everybody that's on the call, have a great weekend. Thank you for attending.
You too. Bye-bye.
Take care. Bye.